Market cycles frequently repeat at specific, measurable intervals. While price action appears volatile, these fluctuations often adhere to a consistent geometric structure. This spiral in a nautilus shell is a physical representation of the Fibonacci sequence, a series of numbers where each is the sum of the two preceding it. In biology, this sequence serves as a roadmap for efficient growth and expansion. In a sunflower's core, the seeds pack together using the golden ratio, 1.618. This number is derived by dividing any Fibonacci number by its predecessor. It is a recurring constant found in the architecture of the natural world. These same proportions govern human biology, from our facial features to the structure of our DNA. When thousands of individuals form a market, their collective behavior, driven by biological impulses of fear and greed, mirrors the same patterns of expansion and contraction seen in a growing shell. The Fibonacci retracement tool maps these biological ratios onto a price chart. By identifying recent peaks and troughs, the tool calculates specific levels where a price move is mathematically likely to stall, providing a framework for support and resistance. Learning to plot these levels allows you to move beyond reacting to market volatility. You can begin to identify reversal points based on the underlying geometry of the trend. Fibonacci retracements require a clear directional trend. In a sideways market where the price is bouncing aimlessly, the mathematical relationships between highs and lows are not strong enough to provide reliable signals. This split screen illustrates the difference. On the left, we have an aggressive impulse move with clear direction. On the right, we have a flat consolidation phase. The tool is only effective on the chart with established momentum. To begin, you must identify your anchor points. These are the absolute boundaries of the impulse move you want to measure. On this candlestick chart, the indicators mark the swing low, the absolute bottom of the move, and the swing high, the absolute peak. These wicks represent the total range of the market's psychological expansion. Patiently, avoid the mistake of anchoring the tool to minor, intraday fluctuations. For the math to be valid, you must focus on the major structural peaks and valleys of the trend. If your anchors are misplaced, the resulting retracement lines will not align with where the market is actually reacting. Identifying these structural points is the most critical step in the setup. Once your anchors are identified, select the Fibonacci retracement tool from your platform's menu. Place your cursor precisely on the tip of the swing low wick. This is your 0 point for the upward measurement. Always draw the tool from left to right to project retracement levels forward into the future. Drag the tool upward and to the right and release your click exactly on the tip of the swing high wick. As the grid locks into place, the software automatically plots horizontal lines at key percentage levels: 23.6%, 38.2%, 50%, and 61.8%. These lines now serve as a predictive map. As the price begins to pull back, each level represents a specific percentage of the total move, where the market is likely to find support. You can apply the same logic to a bearish market that is experiencing a sustained drop. The rule of direction remains the same. You must still draw the tool from left to right to project your levels forward. For a downtrend, click the swing high at the top left first, then drag the cursor down and to the right to anchor on the swing low at the bottom. In this scenario, the retracement levels act as a ceiling. They indicate where a temporary relief rally is likely to face selling pressure and stall. Mapping the downtrend allows you to anticipate exactly where a bounce will likely exhaust itself before the broader downward move resumes. Most charting platforms default to displaying too many levels, which can clutter the screen and obscure the most important data points. Open your tool settings and disable the non-essential levels, such as the 78.6%. A simpler chart allows you to focus on the area where the market reacts most frequently. This area is known as the golden zone, the specific region bounded by the 38.2% and 61.8% retracement levels. This shaded area highlights the golden zone. The 61.8% line is its most significant boundary, representing the inverse golden ratio. Traders monitor this region closely. As candlesticks enter, look for signs of stabilization, specifically around the 61.8% level. Isolating this zone changes your approach from watching a series of lines to identifying a specific high-probability target for the market's next move. By applying these ratios, you have transformed a volatile chart into a structured roadmap based on the same mathematical growth patterns found in biology. This shows the theory in practice. The price crashes into the 61.8% line, hits mathematical support, and instantly pivots into a new upward move. Open a demo account and begin practicing this measurement. Draw 3 retracements on major assets like Apple or Bitcoin, focusing on the clearest structural trends. Once you can identify where a pullback ends, the next step is determining where the move will go next. In the next video, we will use Fibonacci extensions to project specific profit targets. Trading with these ratios removes the guesswork from your strategy. It provides a calculated framework for market behavior, giving you a measurable edge based on the geometry of the trend.